Indiacharts publishes Nifty Daily, daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
Hi everyone, 2021. Happy to be back with my first update into the new year. And one of the things that we learned to do in market analysis is multi-time frame analysis, which means you don't only look at what is happening in the short term, but also look at what is happening in the medium to long term, which means you look at quarterly and yearly charts. And since we've ended one of the most interesting years or eventful years in 2020, you really need to look at what the yearly chart has really done. And when you do that, what you'll find is that on the yearly scale, you formed something that looks like a hammer. A hammer is a long candlestick pattern where prices open at a particular level, they fall steeply. So you have something which we call a long lower shadow, which means that you fall from a particular price, make a huge low, and then you bounce right back to where you had opened and probably close either higher than the open or lower than the open. And so you have this small little box on top, which we call the real body, and then this long bar down, which shows that all the sellers who sold into that low were eventually absorbed by the buyers. Now, when this type of pattern occurs after a decline, we typically look at a hammer as a bottoming formation. But when it occurs after a series of advances, it's called a hanging man. But a hanging man must have a particular size, right? It should be relatable to the pattern that occurred in the previous candle. So, if it is outsized, which is the situation that we've seen now, then it can have very, very different implications. And so I take you back to what happened in 2004, and I remember that very clearly because 2004, after the first bull wave, we did a wave 2 correction, which is a 61% retracement. And that retracement didn't just happen, like it was a slow and steady decline till there was an event. And the event was the BJP election, which they lost, and then the Congress came in and they took support from the left. And the moment they announced the support from the left to make the government, the market went 2 circuits down, hit the 61.8% retracement to complete wave 2, and then started to recover there. Now, Elliott wave wise, it was simple because it's 1, 2, 2 does a 61% retracement. We simply said that this is the bottom and moved on. But sentiment completely turned on its head because people thought that coming in with a left government, the economy will stall or reforms will not go through. And so that was the market reaction that was left behind. What ended up happening though is the wave structure was proven true. At the end of the year, the market had not only recovered all the losses, but ended up at a new high for the year and a new all-time high as well. But what it did in the process is, because it was such a steep decline and then it recovered, on a yearly chart, you've fallen more than halfway into the previous year's candle and then recovered from there. And so you ended up essentially absorbing all the bears into a bullish candle, and then the market continued to move up for several more years ahead of that. Now, what would you call this year's candle? Because this year's candle actually falls into the last 4 to 5 years of advance. It takes out, I think, the 4-year low and then comes back. So this is even more significant sentimentally because everybody who's been investing for 4-5 years would have seen all their gains eroded. And if you actually look at an index like the mid-cap index, it would be almost like you made a huge loss and then recovered from there to end up closing positive for the year. And not only positive, so you're like at a new high. So this is completely crazy. And but what does it mean from a technical perspective? Because when you're seeing such a candle, now it's not like a hanging man, because it should have been the size of maybe the last candle or last 2 candles. And then if you continued higher and then you fall below the hanging man, it makes sense that, okay, you break the hanging man and it turns bearish, which is what the hanging man pattern is. But here the low point of the hanging man is like what was made 5 years ago. So it's like, unless you go below 7,500, it's not even a hanging man confirmed. And so what it really is that everybody who turned bearish, because really speaking, while the Nifty did make a higher high in 2019 and 20, the broad market did not. The mid-cap indices did not. Many sectors were in 2 to 4 year bear markets between 2018 to 2020. And so this was like the last stage of sell-off. And so whoever sold into that final low, where some valuations actually got very, very attractive and still are in some cases, they all got bought into. So you see it, to me, it's the same effect that happened in 2004, that people were sold into because of the negative news event, and then they got completely bought out. And now that they are bought out, there's no looking back. So from a yearly perspective, when you're really looking at the long-term chart, it's an absorption of all the selling pressure, which creates room for much more upside in the years ahead. Now, that doesn't mean that you cannot have a short-term correction, because we've almost had a 9-month rally now, and one has to consider that some indicators will start getting overbought. Like, for example, the daily and weekly RSI indicators have gotten pretty overbought. The daily RSI reached 81.4 I think this week, and last week also, not last week, last month it had reached 81.2, or if I'm not wrong, and that's when you got the big 5 to 6% intraday dip, and then it recovered and closed maybe 3% or so down for the day, and then the rally continued from there. What that did is it relieved the pressure by bringing the RSI back from 81 all the way below 70. So that's what has happened today. Yesterday it was 81.4. Today it's closing just around plus or minus the 70 mark, because you had a more than a 1% intraday swing. And even though we've closed, I think, possibly 140 points down at the end of the day, which is just almost 1%. So you brought the RSI back at least from that extreme reading, and that creates room again for it to continue to push higher as we head towards the big event, which is the budget. But at the weekly degree, we still have an RSI reading of 79. So it's not gone into the 80s yet, but it's relatively high. And as you continue to push higher in the market, it will start getting overbought. And then at some stage, at a higher degree of time, you start looking for what might be a correction. So these are the things with which we head into the budget. And the budget is almost the most looked into event. But more often than not, it ends up resulting in some kind of a near-term disappointment. And the reason is that either the market over-expects into it, or it under-expects. So you had bear markets like in 2016, market was falling because of the new NPAs that were being announced because the banking sector had been told to do so by the RBI. And as the NPAs were announced, the market continued to fall right into the 2nd of February, which was the budget day, and then it bottomed right on that day. And even though last year the peak occurred before the budget, maybe 2 weeks before, the market sold off after the budget, because they were not, even though you had tax breaks earlier that year, they didn't find too much in the budget. So many times what we've seen is policy announcement or reform announcements actually happen outside the budget, because the budget has become nothing but a statement of account. And this was mentioned by former finance ministers also. And since then, this is what has been followed. But the public at large, the markets often look into, maybe there'll be some big announcement around the budget, and, the politicians may use the event to make those announcements. But over time, slowly, finance ministers have moved away from making huge reform announcements, but only making a statement of account, some of which is essentially an increase or decrease in allocation to certain sectors. And that does create some near-term enthusiasm for the day, but eventually profit booking kicks in because everybody's bought into the event, and then you get some kind of corrective phase. So will this year be the same, or will you really have something of an outlier in terms of announcements that could, keep the market momentum going? And the other thing is, how will we relate with the rest of the world? Because other world markets actually look like they are extending in a series of third waves. Now, it's not clear whether those third waves are complete. Some markets you can try and count some kind of 5-wave, but in many markets like in Asia, I'm not able to count them as complete. Maybe they get a little overbought, you get a correction, but they don't look like they're done with whatever they want to do. Specifically Japan, which is now the new booming region of Asia, I would say, in terms of its markets, because it's ended or broken out of that 20-year bear market that it had been doing. And having done so, it's now in a completely different regime shift. So unless you really understand the Japanese economy and what is happening there, things are sort of improving. And again, if we look at China, despite so much of bad news around China, the market's been stable and now is slowly pulling back, making higher highs, higher lows, with a lot of consolidation along the way. So it doesn't really look bearish as of now. So likely that, other markets will not do that. But some of the other markets did see deep retracements in, say, the months of, July, August or September. You almost saw 50% retracement in Malaysia. You saw that in Singapore. So a couple of these markets had deep retracements then, but we were sort of just aligned with the US continuing to make higher highs and higher highs. In fact, even US had sort of a sort of consolidation between September and October. We too saw a correction, but the wave counts are somewhere different, and which is why the views on each market appear to be different. So I wonder whether we see the same kind of reaction that we always do around this time, and even if we do some kind of post-budget correction, will the overall momentum of the world markets continue to drive a market higher eventually? And you'll have to take a stock-specific approach, because what has happened is you've seen different sectors bottom out at different points of time during this entire advance. Like, for example, you go back and look at banking. Banking was the weakest sector in May and June. People were almost writing it off. Even though the Nifty was recovering, we were saying like banks are holding it back and maybe banks will not perform. Even I said that then, that you could see an underperformance, just like you saw banking underperform again in Europe and US after the 2008 Great Recession. So, but eventually banks did pick up at least, and and it took some time for these indices to come close to the all-time highs, and we are still to start making meaningful records. But the banking sector itself bottomed out in July. So that's where a lot of individual names, for example, Bajaj Finance and RBL and even State Bank of India, were actually making new lows all the way into June and July, or maybe May and June if I'm wrong. But that's where the banking rally really started. And some of them even pulled back into September, because even though you had an initial rally, you saw a steep retracement, almost 60%, 80% in some stocks into September. PSU stocks, most beaten down sector till October. Some of the stocks like Coal India made its 52-week low only in October. And so on there, you're seeing the PSU index actually move up impulsively. So you're actually seeing an improvement in the PSU sector as well. So because you have seen this lead lag between different sectors bottoming out at different points of time, which is why the index itself, while every time you may feel that, okay, it's time that it tops out, the rotation is what is keeping the momentum going. So while pullbacks can happen, and they will happen, which is part and parcel of markets, they're going to get overbought and you're going to get those pullbacks. The rotation in sectors is always going to keep the momentum on, is what I'm sensing. Many people would like a deeper correction, like a 50% retracement of the entire move and all that. I will not upfront jump to such a conclusion. I would really want to wait and see the market structure develop before I really take a bigger call in terms of a pullback. And one of the risk factors, I think, which people are watching very closely has been, of course, the dollar, because the dollar has the highest correlation that it has had, say, with equities and commodities in a long time. So, the correlations are running at over 80 or 90% in some cases, especially with equities. And so if that's the high level of correlation, then any reversal usually creates a risk of environment in financial markets. And that's, I think, the fear people are running with, and they keep watching the dollar and they look at the huge positions, which are the net long short positions, and they've been short for a while, especially in the asset managers. So the CFTC Commitment of Traders report gives a breakup. So you have asset managers or managed money accounts which have been extremely short for months and months. Despite the bounce you saw in September in the dollar, they were still short, and the dollar again fell from there. But when you look at net positioning, of non-commercial positions, then you just went into net short for the first time, I think, in this month's data, if I saw in the first week of January. And that again may be early stage. So it's very hard to say whether this is the end point for the dollar where it will make a bigger bounce, or will this just end up being a short-term trigger where you'll get some kind of rotation. The level I'll watch is actually 91. So if we don't really go meaningfully above 91, I think the dollar can still continue to extend on the downside. But if we do go above that, then I'll probably look for a potential risk off environment across different asset classes. So that's my takeaway on the dollar. That's the important indicator that everybody's watching for the liquidity trade, because growth is still taking time to show up in numbers and data, even though you have so much of stimulus, especially in the US. And US markets also remained flat overnight despite the announcement of a $1.9 trillion new package, and they still not announced the infrastructure part, which has been the main driver for the commodities and material space. And one of the indices that I keep watching now is the Dow Jones Industrials and Mining Index, which was highlighted to be by one of my subscribers, and it showed a very similar pattern to what we see in metals or commodities. And so it matches maybe with what the Nifty Metals Index would do, and it's actually racing much ahead. So we would probably be a market which is lagging behind, and it's broken out, I think, this week of the huge multi-year pattern. So that's an interesting place to watch. Whenever it pulls back, maybe it will take support on the breakout point, which is typically what pullbacks do in in technical analysis. Whenever you do a breakout, you get a pullback to test that breakout once more. Most of the time, it's not 100%, but 70% of the time you definitely see pullbacks, and then if the pullbacks hold, that gives you more strength, an idea of more strength for the particular index or breakout, that it's working and it's holding good. So that's something to watch out for as and when that also happens. And so it should be an interesting phase as we run right into the budget. We've got the pullback today, got us at least short term out of the overbought conditions. And next week we're going to be watching the key trailing supports, probably around 32,100 on the Bank Nifty, 14,350, the low we made today. I think if these hold, then you continue to trail your way into the next couple of weeks till you really see a clear reversal in the markets. But till then, it looks like a trend that does not still want to seriously halt, is what I'm sensing as of now. So that's all in this update for the new year, and look forward to more.